When the COVID-19 pandemic struck, almost every sector of the economy was largely affected except the banking sector, as some would say, which according to the Monetary Policy Committee of the Central Bank of Nigeria says remains resilient. The committee indicated that the banking industry liquidity ratio improved remarkably between October and December last year from 35.6% to 44.5%. Reports also have it that monetary development indicates that the broadest monetary aggregates rose to 10.97% between September and October 2020. From 3.2% as a result of growth in net foreign assets and net domestic assets of the banking sector. Now, all these interesting figures recorded by the bank during the COVID-19 pandemic year and still going on, where even the country's economy fell into recession, we're looking at what is the banking sector doing right and what are the fundamentals fueling this growth. Joining me now to discuss this and much more live in our Lagos studio, I have Senior Specialist Risk Management, DMA Advisory and Management Services Limited, Mathew Toyin-Ariyo. Good to have you on the show today.
It's my pleasure.
Now, Mr. Ariyo, let's start off with the resilience which we've seen in the banking sector. It received commendations from the just concluded MPC meeting, the last for the year 2021, and we've seen an impressive front coming to bear in terms of the banking sector. Now, looking at top 15 banks and then looking at our pre-tax profit as well, that's still a robust volume we are seeing there. What do you think is fueling these fundamentals here and not necessarily having that much of a shock hit like we've seen in other sectors like aviation, take for example?
Yeah, I like the statement you made that not much of a shock. The banking industry also received its own share of the shock because going by the PBT, that's the pre-tax profit that you mentioned for the 15 banks, that we discovered that there was a slight drop from 909 billion to 905 by the financial year end of the pandemic year. And that reflected also in the entire banking industry. So, however, there was an increase in gross earning. So, if we are going to judge the growth or the resilience of the banking industry in that pandemic year, even up to this present moment, we are going to look at the gross earnings. The gross earnings grew by two principal factors. One of the factors is that we had the CBN coming to the rescue of the economy by releasing intervention funds. These intervention funds were passed through the banking sector, and that grew the loan portfolio of the banks, and they were able to make money through that. Not only that, there's something we also observe, which we call financialization of the economy. In this case, is as against industrialization. The whole economy seems to be running on the wheels of the financial sector. The growth of the financial sector depends on the growth of the banking sector. So we've seen that during that pandemic year, many people had to rely on the electronic channels of the bank, from which the bank also raked in enormous amount of income. The ATM, the POS, ATM actually grew by 128% in volume of those who used it, compared with the previous year, 2019, as well as the POS that grew by 50%.
And USSD codes and all of those?
Yes, exactly. So those channels, the banking sector has been trying to reinvent itself, re-evolving itself to be able to adopt the digital penetration that is global, and this is helping the economy. That's why it showed in their performance. it was not only, let's note that it was not only the banking sector that grew
Exactly.
in 2020. The telecommunications sector also grew by 13%, as well as agric by 2%, going by the statistics we obtained from the CBN website.
And now talking about the telecommunication sector and the growth we've seen within that realm, and then looking at the banking sector now, we also have to look at some realities as well. Well, investors still largely would choose banking stocks for its stability as well. We see the performance of First Bank, for example. But at the end of the day now, the CBN, the MPC prides itself, and the CBN would say, well, access to credit has increased, hitting an all-time high so far, according to the last report we've had so far. But we still have interventions not necessarily reaching the masses in terms of the engines of growth, MSMEs now. Yeah. There's this school of thought that still think that the interventions or the penetration or the coverage of such interventions have not yet gotten to that level where they have a sustainable reach to reach every single person who needs such funds or initiatives or interventions. Now we hear this call, others are also saying, well, lending rates is also an issue here, but looking at these different realities of the day, and also non-performing loan rates also dropping, and that also raises the question of how is that possible when small and medium-sized businesses are still trying to prop up themselves, come up, because the COVID-19 really hit everyone hard. It was a learning curve, and it's not business as usual. You have to re-strategize, rethink. Now, going by this industry report, how do you tally these various feelers you're getting, which paint different realities at different points?
Okay, I will try to answer that question by saying that small and medium-scale enterprises in Nigeria are supposed to be able to have access to this intervention fund as a springboard, as a supplement from the CBN to reinvigorate the economy. Because the strength of the SME in an economy is actually the strength of the country. Because it is better to give 10,000 people a fund, maybe 1,000, you want to distribute 2 billion, give it to 1,000 people rather than give that 2 billion to one person. So that 2,000 people can make impact and reinvigorate the economy. But this is not, they find it, SME in Nigeria find it difficult to access this because of several reasons. One of which is many of them don't have structure. The structure they have, records that they have, do not qualify them to access these intervention funds. Many don't have, you cannot even track. You can't track you cannot ascertain their projections by any stretch of imagination. So, and everybody wants to access this fund. A tailor wants it, a mechanic wants it, which is good. But do you have the structure? Do you have the track record? They do not have the track record. Not to talk of the problem that they are facing, that every other person is facing, systemic problem of infrastructure that is deficient. We have deficient infrastructure. We have even an inefficient, epileptic power supply, and
bad transportation of resources.
Transportation of resources. You have to depend on so many. The roads are not good. You want to clear something from the port. It's not easy.
Access to raw materials.
Access to raw material is not easy. So, with all this, it makes them so attractive to banks to lend money to. Let's not forget that this intervention fund, banks have 100% risk of it, because whether or not the SME practitioners return the money to banks, banks have to refund the money to CBN 100%. And this fund comes in single-digit interest to enable them build their own business, to raise capital, so that they could approach the bank. The intervention fund is supposed to be a temporary thing, but it's now been taken as something that everybody wants to access and use. That is the reason it fell. I mean, banking exposure in 2019 was 0.71% of the total loans disbursed. It now fell in 2020 to 0.32%, evidencing the fact that banks are not really interested, very interested in them. Not that they are not doing anything about it, because I've seen banks that are trying to encourage them, train them, organize workshops and things like that. But we still have a long way to go to deepen it to that level.
Okay, now, Mr. Ariyo, let's also look at the fact that we are also seeing the narrative of increased access to credit. But at the end of the day, now let's bring some perspective to credit risk assessment. It's a necessary space we also have to look into. Yes, banks are taking the initiative also helping some of these MSMEs put structure into their business operations. But at the end of the day, within this scope of credit risk assessment, what's your word as well to these MSMEs to also get themselves prepared to take up opportunities that prevail?
Yeah, you must have, as an SME practitioner, you are calling yourself a small scale entrepreneur. You have to train yourself how to prepare credible business analysis about your idea, how to understand the environment that you are operating and what you are facing as a challenge, what you are going to be up against, how to even manage funds, liquid assets that you have. Because we've seen situations where people just collect this money and they use it for purposes other than which they are collected. So it falls in their domain to train themselves to be able to do this thing.
And now we're also seeing a fast evolving phase when it comes to fintechs as well, how financial and digital solutions are coming to bear, payment solutions. This is also redefining the interplay we're seeing within the MSME space and even for large corporates as well, actively changing the game. Now, in terms of retail loan segments, banks also restructuring this as well, their revenue profile to ensure that we also drive fees and commissions. In this realm now, what do you think is playing out in Nigeria in the short to medium and long term? How do you see things also playing out? And which banks would you also say are leading the chart in terms of fees and commissions income?
Okay, two questions there. The first is the SME being an integral part of the financial system right now. They have come to stay. And they brought with them technology, digital technology that makes money management easy and faster for the populace. Banks are having to, cope with reduction in their consumer base because of this. They are majorly consumer base. But then, it is a global trend. In globalization, we have a data that shows us that the value of fintechs globally is worth over $100 billion. And CBN also tells us that about in the last 6 years or so, about $1 billion came into Nigeria through these fintechs. Fine. So, but Nigeria, in Nigeria, they have come to be known as the challenger banks. And people are moving to them because of the seamless way they have penetrated, the easy way they have reached the consumer. But one thing is that they came with an array of products, and one of the products is crowdfunding. Crowdfunding is the in thing now, in which small savers, pool of funds come together and they are able to mobilize this. Not only that, the payment services that you mentioned, they are playing a very strong role, and they are outsmarting the traditional banks in this space. The third is the loan. the loan, being offered to the public, you just get a blip on your phone that says you can access 4 million naira in the
less than 24 hours.
In the next 24 hours. So they are into all these things. So banks are trying to respond to this challenge by also updating their digital channels, making sure that they partner. Some of them even partner. UBA partner with Layers or something like that. Very recently, Wema has a lot, and some other banks like that. It's either you start your own fintech from scratch, because the traditional banking's technology cannot easily be modified to suit the style, the modus operandi of the fintechs. Well, one thing I must also say is that the fintech should better watch, because these loans in the long term, you said short, medium, and long term. These loans in the long term, many of them will be saddled with non-performing loans. Although today they are factoring in the risk into their pricing model. You see that the rate of interest they charge for those who have the license to lend is much more than the banking sector. So what I'm saying is that they should also bring in risk management into their mode of operation. They should have frameworks, because there are no two ways. No way. The second way out is difficult, and you'll be losing money. You lose your capital at the end of the day if you go on carrying non-performing loans.
Now, let's also look at performance from the scope of ratings. Now, we have agencies like Fitch Ratings also coming into bear, and when you move from stable to negative to positive, that also throws whether or not some confidence or dropping confidence in terms of how well the banking sector is performing for individual banks, whether they're profitable or not, whether the operations is seamless and moving well or not. In terms of the reports we've had so far for the year 2020, and also looking at the index, which would also define the year 2021, and prepping ahead for 2022, how do you see the figures moving?
Yes, banks that have wide range of
taking into consideration, we have different tiers of banks as well.
Oh yes, we have tier 1 banks. Just I thank you for bringing that in. Tier 1 banks, we all know them. They are big, they are strong in terms of asset base and capital adequacy. So, and they have a large network of branches through which some of them are doing agency banking and penetrating the unbanked population. So this is keeping them going, about 5 of them. You have the First Bank, Access, UBA, GTB, and one more, First Bank, Access, GTB, UBA. So these banks are very strong, and they dictate the pace. In fact, they control about 68 to 70% of the asset base of the banking sector. So they are able to rake in a lot of non-interest income. So if interest, for instance, goes down, as the MPR may come and interest rate may be dropped and things like that, they have the second way of making money through the non-interest income. They are solid and they generate adequate internal capital as they go. So when we rate them, you will rate those banks ahead of the tier 2 banks. Tier 2 banks, they are, and if you rate the banks across the board, the space, you look at their capital, we only say the ones that are tier 3 banks are the ones that have negative shareholders fund. So the rest fall in between, which we call tier 2 bank. By and large, the banking sector is solid. And we also want to rate them by looking at the non-financial figures, not only the financial. Non-financial figures, like in that year pandemic, 2020, if you rate the banks, how they responded by contributing in their CSR report that we have, you will see that banks like UBA came atop 5 billion donation from something less than 800 million in the previous year to 5 billion in that year because of the pandemic. I think next was access, and like that. We read them along that line. CSR, contribution to the economy. So, and even employment generation. First Bank is the highest employer of labor in that industry. About 8,300 workers. And we also want to look at those who grew their employment in that year. You have banks like even Unity Bank, Keystone. They scaled up the number of their staff. So we rate along monetary and non-monetary parameters. And we see that the first 5 banks, they are doing strong, and all other banks as well.
We can talk about ratings as an individual element or in silos without looking at the area or the practice of corporate governance as well. This also makes or mars your performance. Now, this year we had a shake-up where the question of corporate governance practice for one of the biggest banks in the country also raised some eyebrows, and it took a whole lot to have the reassurance in terms of the public's buy-in into the bank. Now, how do you see us also improving on this practice, knowing that the banking sector also has this element where we have the electric eels, quite slippery to catch, or compliance is difficult to ensure? How do we deal with these?
Well, I will not agree that compliance is difficult to, because CBN has something called the Corporate Governance Code.
The natural human element here is to always revolt where there is some level of sanity.
Oh, yes. So you are expected to comply with this code. And if you are not, the external auditors are there. Considering the number of people that are on the board, you are going to mix the board. The board, some will have, you are expected to have non-executive directors that are more in number than executive directors. Those who decide the fate, the mission, and the vision of the company, of the bank, will be the ones that are professional. When these are factored, it is expected that each bank also develops their own corporate governance code. And these codes are expected to be complied with. If they are not complied with, what is the external auditor doing? The signals have been there that some people are, they will be the system. But then, I believe the CBN is capable, external auditors are capable, NDIC, they look into this thing. In fact, there was a time that CBN has a permanent seat in the boardroom. So maybe we have to go back to that era to ensure that corporate governance code is complied with.
Thank you very much for your time on the show today, Mr. Mathew Toyin-Ariyo. It's been a pleasure speaking with you, and we'll keep our fingers crossed. The year 2021 is gradually wrapping up. We'll see how things would also play out in 2022. We'd like to see the banking sector continue with this level of resilience and stability. Thank you once again.
It's my pleasure to.